As we do every week, we're going to be reviewing my $434,000 dividend stock portfolio, but hands down, this market makes zero sense. This is one of the most surreal recessionary environments I've ever experienced in my investing career. I mean, take a look at this. Apple, for the first time in like several years, saw a $6 billion decline in iPhone sales. Mac sales down by a few billion bucks. The only thing that really increased was iPads, but across the board, most of Apple is seeing a decline, which is kind of crazy to think that the stock actually rallied on that news. It's up 3.3% after earnings, up 24% year to date. Meta stock seeing a whopping 41% decline in net income year over year, doing $40 billion in share buybacks. And take a look at the stock here, guys, up 54% year to date. In the last 5 days, a 30% return. Spending all this money on Reality Labs, it's like we're in some reverse realm of everything just flip-flopping into something where you post bad numbers and hey, your stock's going to the moon, baby, because Amazon, though their total net sales for the first time crossing $513 billion. Can you even wrap your mind around that insanity, going from $469 billion the year prior? And even with this crazy, still exaggerated growth, the stock actually dropped on its earnings, down 4.7% today. But year to date, I mean, this thing is still crushing it. And there's only one way to define this market, and it's this meme right here. I mean, if you weren't buying the lows or you ended up selling the lows, like the Michael Burrys, the Peter Shivs, the Rich Dad Poor Dad, Robert Kiyosaki's of the world, dare I say, you're not enjoying this by any metric. And I don't know if this is going to last. We should see profit taking at some point. What's driving this rally? Perhaps just the institutional savings accounts. We talked about how we're at 20-year highs basically for money market funds, and maybe that's just flooding back into the market. I really don't know what's going on here, but it's like reverse la la land. And this is why it's so prudent to be cost averaging into the market. I mean, we put over 10,000 in the October lows. I put over 20 grand in Taiwan Semiconductors just in January, and damn, am I seeing the benefit. We're going to break down the individual stocks here and just see how they're doing since January's hit, this 2023 market. But my God, for the first time, the portfolio is over 404,000. I'm up $14,000 since I did a full repositioning into ETFs going into the first quarter of last year. I'm sitting on a really healthy amount of cash with over 30,000. I'm going to continue to stack cash, not because I don't want to cost average here, but obviously I'd like to see a breath taken and see some profit taking. But primarily we're going to be getting RRSP contributions. We're going into the tax season, so that's coming up. The Canadian government's introducing the first time home buyer savings account, which is a brand new tax advantaged investing account, and I do want to take advantage of all of that, so I'm going to keep stacking cash, and this is all coming up in the next couple months, so that's what I'm going to use that cash for. And I'll probably just keep cost averaging into these ETFs, and that's what I've been doing with the dividends still. I mean, we're sitting on $12,400 in annual dividends, and that whole time just collecting that income that doesn't equate to the capital gains. So 3.18%, the yield's probably going to stay around there as I just keep buying the same stocks I'm holding now. Not really looking at adding anything new just yet. We'll see what the market brings this year, but my God, what an insane start to the year. Now, before we dive down, just to see how the individual positions have been performing through 2023, if you want to support the channel, come to portfoliospreadsheet.com, where you can kind of get this really beautiful overview, so your dividends, your diversification set, and just how you've been investing between all your different accounts. Support the channel, guys. The link's in the description below. We just launched the Excel version here on portfoliospreadsheet.com, and the price is only $14.99. I had to pay thousands of dollars to get developers to make this stuff, to bring it to you this damn cheap. So try it out. They're really fun platforms, and I definitely appreciate it. But getting into this, guys, you have to imagine, with the amount of money I have in these individual investments, these little bits of movements are worth lots of money. It's kind of astounding, really, to see VDY up 6.5%, considering I have like $150,000 in this company. So you got to imagine that's like $10,000 just in cap gains before the dividends. VOO up 9.15% since the beginning of the year, which is crazy. I've got over 100,000 US in this investment, so that's like a $10,000 gain. SCHD, though not nearly as resilient in the market rally, only up just under 3% year to date, but on the 5-year basis, this one isn't down at all, really. So you have to imagine this has been a great stabilizer, an investment that I'm going to continue to cost average into, because it offers that real good balance and stability. It gets rid of the volatility in one's portfolio, whereas TSM, as mentioned, I want to still continue to outperform the market, so I'm going to make some really strategic bets that are going to excel the broader index fund gains. So we can see Taiwan Semiconductors is still down about 20%, but year to date, since we've been cost averaging into this and my average buy is around $80, we are up a whopping 19-20%. I really hope this one takes a breath. I've kind of got my maxed position in it, but I like buying these things on dips, guys. It's exciting to see these rallies. It's fun. Everyone gets pumped up, but the reality is I want to become a millionaire this year, and the only way I can do that is by buying really aggressively in these lows, knowing that come 2025, if the market goes to the way I think it's going to go, we're going to get that propulsion, that rocket ship that's going to really take us off. But I need to keep buying these dips, and we're just not seeing them right now. So it's kind of frustrating, to be honest. We've got my small cap investment, Aduro Clean Technologies, up 13% year to date. Like, you could have just threw a dart at the board. You're not a freaking genius here. Don't act like you're one. I feel like people kind of get up in arms. They buy one stock or one cryptocurrency and they're like, oh, I knew this was going to happen. And it's like, no, you didn't. The rising tide raises all ships. Nobody can predict this stuff. It's pure fugazi and gambling in the short term, right? But taking a look at just one broad perspective on the economy that just doesn't make sense to me, because history repeats. Well, it doesn't repeat, it rhymes, right? And there's no past, recession or stock market crash that can even come close to comparing to what we're seeing here, because the jobs market, like I was listening to Jerome Powell at the Federal Reserve speak, and he just pointed out that the jobs market is out of whack. It doesn't make any sense for there to be this many jobs when we're seeing all these layoffs in tech companies. Yet all those people getting laid off, they're finding jobs a month later. You're seeing real estate and construction cool down, yet those people are still able to find work. I'm busier than I've ever been in January, which is kind of just hard to wrap my head around, because when you look at the news rhetoric in the media, this isn't what the jobs market is supposed to look like. So if this doesn't really change, I can't foresee why we're not heading into a soft landing. But just listen to Jerome Powell's comment.
Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago.
Again, just take a look at the past here, guys. During 2008, we saw a massive spike in unemployment, full recession. In the March 2020, the pandemic period, boom, massive spike in unemployment here. Everyone got laid off, short-term recession, and boom, now we're just in this really unusual, surreal environment, something that I think is going to be a learning lesson for the ages. And if you are witnessing this right now, you are part of history, unlike something we've ever seen before in the past. I mean, look at this, right? Like, taking a look at the watch list, guys, we saw Apple, Google, Amazon, Starbucks, Ford, Qualcomm post numbers yesterday. Qualcomm numbers not the best, yet the stock rallied. Apple's numbers not the best, yet the stock rallied. But Google, Amazon, Starbucks, these are all getting hit. Starbucks obviously dealing with the pandemic in China, their China store seeing a slowdown in sales. That stock dropped off. Ford getting hit 6%. I mean, these numbers are just so damn confusing. It just doesn't make any real sense. But if you guys are enjoying the journey, you like the updates, consider supporting me on my Patreon account. I just started allowing you to join my private WhatsApp group where you can talk with me and many other 6 and 7 figure investors, where we literally talk 24/7 about the stock earnings, anything going on, or questions that you're interested in. For the first time, I'm letting you guys have access to that. And it's literally $5 a month to support me on Patreon. It's literally less than a Starbucks coffee a month, guys. And I think I'm offering 10x to value. So support the channel unsolicited, unsponsored, and continue the conversation with me there.